Welcome to Retiring Today. Market volatility is back. What can you do? 3 strategies. So we're gonna outline this for people, because if you do log onto your 401k, let's say you're not working with a retirement planner, you see it down 20 or 30%. Nobody likes to see that. I don't care if you're 20 years from retirement or 2 years from retirement. Nobody wants to see that. So some strategies. Let's talk about something you can do right now. Avoid emotional responses. Let's break it down. What does it mean, Loren?
And this is probably one of the most important strategies that you can implement, and one of the most difficult strategies, because as you mentioned, you log into your 401k plan, you log into your IRA, and your $1 million portfolio is now $800,000, and all you're doing is calculating in your mind how long it took you to make that $200,000. Right. And it took, 3 months to lose that $200,000?
That's hard to see.
It's devastating, and it can really eat at your retirement heartstrings. So one of the tempting reactions to that is to just push some buttons and go to a more conservative investment like bonds, or maybe even to cash. And there's been study after study that has been conducted. It's not about timing the market, it's about time in the market. And one of the number one ways that people can dilute the returns that they receive long-term over their portfolio is by trying to time the market. Because when you push that button and you go to cash, that's one decision, and that decision, on the surface at least, is relatively easy, right? You see your portfolio going down, you just want to save it, push the button, you go to cash. Now you have to decide, when are you going to get back in the market? Because you know, especially with inflation at 8+%, cash isn't paying you anything. You're actually slowly losing money when it's sitting in cash. So you know you can't stay there forever. When are you going to get back in? And that's one of the hardest decisions. It's not just one decision, that's a 2-decision, if you will.
Yeah, we know what you mean.
And it's a challenge. And again, study after study, very few people have consistently got that correct time and time again.
And this emotional investing, this happens in both winning markets and in losing markets, because we're all humans, right? And we're probably driven by greed and fear. So when the market's up, we all want to jump on that bandwagon. You know, you see your neighbor making money off of Tesla or Amazon, and you think, oh, I want to get on that bandwagon.
Bitcoin, yeah.
And so you follow the herd with them. And so you emotionally, you don't want the fear of missing out, so you emotionally buy in at the wrong times because of that. And then when the market's down, you want to move your cash to the sideline, because that's where you see big sell-offs. So I don't know about you, but if you ever sat in your house on a Sunday afternoon, the day of rest is what I like to call it, and I go see my neighbor mow their lawn, and then I see the other neighbor mowing their lawn, and then by 15 minutes later, I'm out there mowing my lawn.
Sure.
That's herd mentality. That is behavioral ways that we react, and the same thing applies to the stock market.
Yeah, and it's where having a professional on your team can come in handy, because both of you look at the stock market a lot differently than I do as an individual investor. You look at performances over the last 20 years. If you want to talk to this guy for a while about that, he's got all the numbers. He can tell you what happened in 2008 and 2001. I mean, that's part of your job too. So I can sit down with you and say, hey, Loren, look at my 401k. And you go, yep, I'm sorry that you don't want to see this, but historically, let's look at this and let's look at how this fits your plan. When is your retirement date, Molly? What other assets do you have? What else have you saved up? It's good to have someone who's a little more objective.
That's one of the big benefits of having a retirement planner or an advisor on your team. And really one of the big aspects of our job is to help you do things that you otherwise wouldn't do if we weren't on your team. And those things that you otherwise wouldn't do, you wouldn't do them for a multitude of reasons. Maybe it's because you just don't know, right? You don't pay attention to the history. And especially when we're talking about the stock market, history does repeat itself. So maybe you just don't pay attention. Maybe you don't want to spend your late nights reading tax law and doing all those kinds of really fun things.
I think that's what he's doing.
Or maybe it's just your emotionality gets too big in these types of moments, and it makes you want to do things that you know you really shouldn't do, but you just can't control it. And that's why, in big part, we are there, is to help you do some of these things that you otherwise wouldn't do.
Yeah, and usually emotions, they happen because they're reactions, right? And so that's why it's so important to talk about, this is going to happen. We're going to see bad market environments throughout the course of our lifetime. So this is what we can expect, but we can plan for it. And then we can build in strategies to your investment plan so we can take advantage of these market dips versus being so scared and moving out to cash.
And I'm going to go back to something you said that I need a little clarification on, so maybe somebody out there does as well. You said if you go to cash, you're effectively losing money. Can you explain that?
Yeah, if you think about going to cash, I mean, what are the banks paying you right now? It's come up a little bit, but even though interest rates have come up, what the banks are paying or what these guaranteed or cash instruments are paying are very little, less than 1% in most instances. So if you're returning less than 1% and you know you're going to have to pay taxes on that money at some point, so you take away the taxes and then also inflation. The historical average inflation, the last 114-year average, talk about the numbers you were referring to,
Yeah, you got them all.
is a little over 3%. But right now, or as of recent, it's over 8%. But even using that 3% long-term number, you're making less than 1. You got to pay taxes on it when you take it out, and you're losing purchasing power at the clip of 3% long-term. Even with that number, you're safely losing money. Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.